Good afternoon. My name's Helen McIntosh and I'm the President of the South East London Chamber of Commerce, and welcome. I'm delighted we have another joint event with Thackray Williams, and we're going to hear today about wills and tax planning for business owners. Before we go on, I'm just going to ask people, if it's possible, can you put your video on so we can see you? Oh, I see Terry's just switched on. Lovely, because it's really nice to be able to see everyone's faces. We will be having questions at the end, and we're not in the real world at the moment, we're in a virtual world, but it's going to be like the real world, because if you want to ask a question, will you put your hand up, put your little electronic hand up, and then Ed will invite you to ask your questions. So I'd like to introduce you to our speakers today. We have Elliot Lewis and Zara. I'm so sorry, I can't read you. I've lost my notes now. Zara, would you say you're Kanani? I've got it right. Apologies there. And I'm just going to hand over to them. And questions at the end, please.
Great. Well, thank you very much for that, Helen. It's lovely to see everyone. And thank you for inviting us along. We want this to be as helpful for all of you as possible. So very happy to answer any questions you might have as we go through the talk at the end of the talk. So if you can please save them up for the end and let Ed know if you do have any questions. I'm proud to say that I head up the firm's private client department. We have been in Bromley area initially since the 1940s. So as a firm, we've been going for about 75 years. The private client team consists at the moment of 15 solicitors with over 200 years of experience between us. It could mean that we're all getting old. I like to think it has a more sort of positive connotation than that. All that experience, we share a huge amount of knowledge between us, and we try and bring that to bear to really support our clients in trying to achieve their goals. So lots of combined knowledge and experience. It's very rare that we actually come across and see a client whose situation we haven't seen before. And for us, it's really getting to know our clients at a pretty fundamental level, so we can provide the best advice that we can on behalf of those clients. We're going to talk through the sort of inheritance tax landscape, particularly with a focus on tax planning for business owners. There's lots of things that people can do. The question always is, should you do it, and is it right for you? And to enable us to answer that, we often need to get to know you and really get to know what your goals are. I'm delighted to hand you over to Zara, who's a colleague of mine, who will take us through the first part of the talk, and then I'll come back in when we get to talking about business relief. So if I hand over to you, Zara. Thank you.
Thanks very much, Elliot, and good afternoon, everyone. And thank you to Helen for having me on. So if I can now just get my slides to work. So the first part of the talk is just going to be an overview of wills and the inheritance tax landscape, but it's important that we have an understanding of the background before we go into how this applies to business owners. So to start off with the obvious question, what is a will and why should I make one? So a will is a document that deals with the distribution of your estate on death. Although the document is made in your lifetime, it doesn't actually come into effect until the point of death. On another slide, I've got some details on what your estate actually is. So we'll go through that in a little bit of detail. Your will can be changed at any time up until the point of death, subject to you having the requisite capacity. Often we see clients that have lost capacity, whether it's through illness or accident, that no longer understand what's happening around them, and that is the point at which they can no longer make or change or update their will. So why should I make a will? In its most basic form, a will gives you control over the distribution of your estate. You are allowed to choose who your executors are, so those are the people that will administer your estate according to your wishes. And if you fail to make a will, as we'll see a bit later on, the law steps in and decides which of your family members inherit from you. Now, that may not always be in line with your intentions. So a will allows you to take control and to make sure that your estate is distributed in the way that you intend it to be distributed. A second way is or a second reason to make a will is to minimize inheritance tax. And that's something that we're going to be talking about a little bit later on. And lastly, ease of administration. When somebody passes away, you generally have to go through a process called probate. It is possible if somebody dies without a will, but it is much easier if there is a will in place. So just speeding up things and dealing with the estate becomes much easier if there is a will already there. So what does the estate include? What can your will cover? So your estate is absolutely everything that you own at the point of death. So that includes cash, so balances in bank accounts, ISAs, personal possessions, clothes, jewelry, personal effects, property, whether that's the main home, buy-to-lets, other investment type properties, commercial properties, any investments that you may have, shares in companies, whether they are quoted or unquoted, any interests or any assets that you hold as part of a partnership, or any assets that you may hold as a sole trader. Your estate also includes assets that are held outside of England and Wales. The following assets generally do not form part of your estate. So these are assets that are not capable of being included within the will. And they tend to be assets that you hold jointly with another person. So for example, property that a husband and wife hold together can in some certain circumstances fall outside of the scope of the will. Similarly, bank accounts as well. Any insurance or life policy that is written in trust for somebody else other than yourself doesn't form part of your estate, and neither does a private pension. Again, there are some exceptions to this, but generally private pensions, if structured correctly, don't form part of your estate and therefore cannot be dealt with by your will. In order for a will to be legally valid, the individual making it must be an adult, meaning that they must be over the age of 18, and they must have the sufficient mental capacity to make the will and to understand its effect. And part of our role as solicitors is that when we go through a discussion on the will with somebody, we are assessing capacity as we go along. It generally isn't, much of an issue, but sometimes we do have very elderly clients where capacity can be an issue. And in those sorts of circumstances, we may be required to get a medical report if we are in doubt as to whether or not that individual understands what it is they're purporting to do. A will is only valid if it's created without any pressure from anybody else. Often, sadly, we do see situations where, just one that I had not very long ago was where an elderly parent was being forced to make a will in a particular way by their children. Again, we have to be very vigilant of that. We are gatekeepers in a way to making sure that somebody's wishes are captured in the way that they truly want them to be captured and not in the way that benefits somebody else who also has a vested interest. A will has to be in writing and signed. There is some debate, particularly, since the pandemic has started, as to whether electronic wills are something to be considered in the future. I believe Australia and New Zealand have passed laws that allow wills to be signed and to be created in electronic formats. We're not quite there yet here in the UK. Our Wills Act is still governed by a piece of legislation that was created back in 1837. So we're still a while away from that kind of progress. In order for a will to be valid, it has to be signed by you in the presence of two adult independent witnesses. So two people that are completely unconnected to the process whatsoever. People sometimes often make the mistake of asking their beneficiaries, so the people that they have named in the will, to be a witness for them. Unfortunately, that is a problem, because any individual that is named in the will as a beneficiary, along with that individual's spouse and children, cannot be a witness. Otherwise, if they are, they forfeit their entitlement under the will. So it's very important to make sure that these rules are observed so that the distribution of the estate is upheld. I put on this slide a flowchart as to what happens if you die without a will. Where does your estate go? But broadly, there are three basic scenarios. Scenario one is that you pass away without a will, but you leave behind a spouse. In that situation, the spouse receives everything. The second situation is you may die, but leaving behind a spouse and children. In that situation, the spouse receives the first slice of the estate up to the value of £270,000. The remainder of the estate is then split equally between the spouse and the children. And the last scenario that is common is that if somebody passes away without leaving a spouse or children, in that situation, the law steps in and passes the estate to wider family members such as parents, siblings, grandparents, aunts, uncles, in certain cases cousins, and if nobody's there, then the estate goes to the Crown. Now, somebody might look at that and think, well, I have a spouse and children, and if I die without leaving a will, I'm happy for my estate to go to my spouse and my children. Why do I need to make a will? The problem here is that if you pass away and your estate is above a certain value, which means that it triggers inheritance tax, the portion that passes to your children could trigger inheritance tax, whereas the portion that passes to your spouse doesn't trigger inheritance tax because spouses are exempt. You may not necessarily want that to happen. So having a will to override that default position from a tax point of view is always beneficial. One point that is worth noting is that sometimes, you know, as we see different family structures that have arisen over the last few years, and people may not automatically choose to get married anymore. They may choose to cohabit with their partner. There is no provision for a cohabitee to inherit if you do not include them within your will. In that situation, things can become problematic. The cohabitee, if they've been in a relationship with you and have lived with you for more than 2 years, they have a right to challenge the will. But when you get into litigation of that nature, things can become very acrimonious and very difficult. So again, if you are in a sort of non-traditional family setup, having a will is always a good idea to make sure that the people that you care about are protected and provided for. I wanted to touch briefly on inheritance tax because I think what I've certainly noticed from my work in this area over the last 10 years or so is that it's not something that everybody is aware of. And I think a lot of people don't understand that it can apply to them. So inheritance tax is a tax that is paid on somebody's estate when they pass away. I believe last year's figures that the government released, so this is looking at figures prior to the pandemic, the government raised, I think it was about 5.2 billion from inheritance tax. That will obviously have increased over the scope of the pandemic, given sadly the increased number of deaths that have occurred. So those figures are yet to be released. But if you're looking at sort of 2019, 2020, the government's revenue from IHT alone was in the region of about 5.2 billion. There was some discussion that there would be a simplification of the legislation when it comes to inheritance tax. We were expecting some changes in the budget this year, but the focus of the government was more on recovery after the pandemic rather than having, you know, they didn't necessarily have the resources to undertake a full review and a full overhaul of the tax system. So at the moment, this is what we still have and are likely to have for some time going forward. So inheritance tax is a tax that is paid on death, and it's paid at a flat rate of 40%. In certain circumstances, the tax rate can be reduced to 36%. It's not very common, but it can be, and certain conditions have to be met if the estate pays tax at 36% as opposed to 40%. Every individual has what is known as a nil rate band allowance. This is an amount that is not subject to inheritance tax. Anything above this is subject to inheritance tax at a flat rate of 40%. And that level, that figure is frozen at 325,000 up until 2026, as was announced at the budget this year. Again, this nil rate band allowance figure tended to increase year on year, albeit not in line with inflation. For all of the years that I've been in practice since 2009, it's been frozen at 325,000. I've never known anything else in my years of practice. I've never known any other allowance. So it's been frozen at 325,000 since 2009. And will be frozen at that level at least until 2026. One thing to be aware of is the 7-year rule, and this is something that you may very well have come across. If an individual makes a gift, whether of cash or any other type of asset, to individuals in their lifetime, and they die within 7 years of making that gift eats into their allowance. If they survive the full 7 years, after making the gift, the allowance is simply refreshed and the gift falls out of account. But that's something that you need to be aware of, because if you do die within 7 years of making a gift, the chances are that not all of your allowance will be available to offset against the value of your estate, meaning that potentially more of the estate could be subject to inheritance tax. For married couples, the allowances can be added together. This is hinged on your traditional scenario where husband and wife pass away, making wills, leaving everything to each other. At that point, there is no inheritance tax to pay because anything that passes from spouse to spouse is free of tax. And what happens is the allowance of the spouse that dies first simply gets transferred across to the estate of the spouse that dies second, meaning that married couples tend to have an allowance of 650,000 before any inheritance tax is due. As of 2017, the government introduced an additional allowance on top of the basic 325 for single individuals and 650 for married couples. This is called the residence nil rate band, and it's currently valued at £175,000 per individual. As with the normal allowance, it is transferable between spouses. So if spouse 1 dies, leaving everything to spouse number 2, spouse number one's basic allowance of 325,000 and residence allowance of 175,000 is transferred across to spouse number two's estate. When you add together all of those allowances, a married couple between them has up to £1 million worth of allowance before any inheritance tax becomes due on the second of their deaths. So inheritance tax planning only really becomes relevant for a married couple if the value of the estate is more than £1 million. Now, it sounds like a lot, but if you think of your average family that has the family home free of mortgage, some cash, some investments, it can rack up pretty quickly. And the majority of our clients do actually fall within the 1 million plus band. If the estate is above £1 million, the client may very well look to carry out some tax planning measures in their lifetime to try and bring their estate below that 1 million level so that no inheritance tax is payable when the second of them passes away. One thing that I just want to focus on, which is a slightly difficult topic, is the residence allowance. So this is the additional allowance of £175,000 that is given to each individual. Now, this £175,000 allowance only applies if you own a property which you have lived in as your main home and passed down to your children. If you are a single individual that has no children but has a property, then you don't get the benefit of the residence nil rate band or the residence allowance, because it only applies where you have property that passes down to children. The definition of children is quite wide. It can include stepchildren, so blended families can take advantage of this as well. It also includes foster children as well. So it's not just your biological child. It is any individual that is really treated as a child of the family. But the residence allowance only applies if the family home passes down to these individuals. If, as is often the case, a property is sold in an individual's lifetime, such that when they pass away, their estate holds the cash instead of the actual property itself, provided certain conditions are met, the residence allowance can apply to the cash balances that the estate holds. There are some pretty detailed conditions, and I don't want to go into them too deeply right now. But one sort of key point that I've put on the slide is that if you do sell your house, please remember to keep the paperwork, because if we needed to claim that allowance on your passing, that paperwork from the completion will be necessary. One very important thing to be aware of is that if the value of the estate exceeds £2 million, the residence nil rate band, the allowance of £175,000, is tapered off. So for every £2 that you are above £2 million, you lose £1 worth of your residence allowance. So between a married couple, by the time the estate gets to 2.7 million, the residence nil rate band or the residence allowance is lost entirely. So again, for a lot of clients that are sort of between the 2 to 2.5 to 2 to 3 million mark, part of their planning is focused not on getting them up to £1 million, because that's almost impossible, but at least to try and get them as close as possible to the 2 million mark to bring that additional 175 allowance or 350 between a married couple back into play. So again, it's the residence nil rate band isn't just a blanket allowance that applies to everybody. It only applies if you have a property that's going to children and where the estate is worth less than £2 million. So automatically, some people are taken out of the scope of that allowance and it doesn't apply to them. So as I said there on the slide, wealthier clients often go on to lose this allowance completely. And for those of you that have businesses that have got business assets, whether you hold them as a sole trader, whether you hold them through a partnership or through a limited company, although those business assets benefit from certain inheritance tax reliefs and exemptions, their value is still included when adding up your estate. So if including those assets takes you above £2 million, then you although you may get relief for some of those assets, you will lose the benefit of the resident allowance. I appreciate that's been pretty technical, but I'm happy to take questions on any of that at the end. But I'm going to hand over now to Elliot to talk a little bit about some of the other exemptions and reliefs, in particular business relief.
Great, thank you very much, Sarah, for that. And that was hopefully a helpful run through of the sort of general inheritance tax background. One thing which we do speak to lots of clients about is the use of charity exemption. Obviously, the government are trying to encourage charitable giving, as a result of which any monies, assets that you pass to charity, either during your lifetime or on death, are completely free of inheritance tax. So that's something which clients do use. In one of the slides, Zara mentioned that there were two tax rates for inheritance tax, 40% and 36%. Not commonly known, but if you were minded to give up to 10% of your taxable estate to charity as an encouragement for doing so, the government have brought in a lower inheritance tax rate of 36% to try and encourage people to do that. I've crunched some numbers with a number of clients on this, and effectively, when you take into account the inheritance tax relief you get on the gift to the charity, and the fact you get charitable exemption, for every £100 you give, it sort of, you get 67 pounds of effective tax relief back. So it actually really only costs your estate £33 for about every £100 you give. So for some clients, actually, that's quite a useful incentive. And I've spoken to a number of clients about the use of that, and we put it in wills. There's some clauses that we can put in really to maximise the benefit of that relief and exemption. Business relief, which is the main purpose of the talk today, is, I always think with inheritance tax reliefs, the best way of understanding it is, what are the government trying to get at? What activities are they trying to encourage? And the idea behind the tax relief is to eliminate inheritance tax charges on the breakup of a viable business. What they don't really want to happen is when someone passes away, a business owner, that business has to be broken and sold simply to fund a tax bill. The government see it as a good thing for society to encourage entrepreneurial activity. The inheritance tax landscape at the moment, I think, for businesses is as favourable probably as it's ever been. There are two rates of inheritance tax relief, either 50% or 100%. What the government are trying to encourage is trading activities. So you have to look at the business itself and make sure that it's wholly or mainly a trading entity. There are some exclusions where you make or hold investments, dealing in land or business, or stocks and shares. I've got a number of clients who have family investment companies that primarily hold rental property or a bank of stocks and shares. They don't get business relief, although it may be within a company structure. The government see that purely as investment and then tax it accordingly. The two rates of relief are 50% or 100%. You get 100% where you have an interest in a business. It could be a partnership share, sole trader, or shares in a private limited company. As long as you've been trading for at least 2 years, there's a 2-year period of ownership, you get 100% relief on the value of that interest. And the interest could be of any value. It could be £500,000, £1 million. I've got one client who's got tens of millions of pounds of business interest, all of which at the moment get 100% tax relief. So it's potentially an extremely valuable tax relief. Land, buildings, machinery, or plant owned by an individual in their private name but used by the company, if they have a controlling interest in the company, they will get 50% inheritance tax relief on the value of that. I had a client of mine who lived quite close to our West Wickham office, who personally owned the premises on which his business was run. He had 51% shareholding in the company, and that, on his passing, enabled his estate to claim 50% inheritance tax relief on the value of the premises. So again, that was a useful relief, and it managed to save a few tens of thousands of inheritance tax. With the 2-year period of ownership, if you leave your assets, your business assets, to your spouse, they will inherit your ownership period. So if you're a year and a half through, or if you're past that and you're 5 years down the track, whatever period of ownership you have, your spouse will pick that up. Any assets you leave your spouse get spouse exemption. So you'd really want to have a think about the best way of maximising your business relief. And we're going to go on to talk about how you might do that. The other thing which catches some clients out is that you won't get tax relief if your business is subject to a binding contract for sale at the time that you make the gift. I've seen this on a few occasions where, if you look at the company's documentation, on the death of a shareholder, there is a binding contract that you have to sell the shares to the other shareholders. If you do that, what the revenue say is that your interest isn't actually in the business at all. It's simply in this contract for sale. It's in the cash proceeds, and therefore they don't give you tax relief. I'll go on to talk about, we've got a case study and I'll talk around how we might get around that particular issue. You also have to be careful. There's a clawback on lifetime transfers. If you gift assets, which at the time you make the gift attract business relief, but then those assets become something else. So you sell the business and turn it into cash, and cash isn't an asset which gets business relief. And then you die within 7 years, but after the sale, there is a clawback on those, and you're likely to lose the relief. So again, it's something which I've talked to a lot of clients about. If you are thinking about gifting shares across, in this case, we were talking about gifting shares to children who are involved in the business, you need to have a look ahead really to see what the plans for the business are. In this particular case, the client was thinking about selling the business in 4 or 5 years' time. And if they then passed away between the 4 and the 5 years and 7 years, just at the wrong moment, that would have caused quite a big problem. If you can move on to the next slide, please, Zara. Case study, Mr. and Mrs. Smith. It's very original, obviously, on the name. Mr. and Mrs. Smith, we thought it was helpful just to give a bit of a flavour of the sorts of clients we see and the issues which people face. So Mr. and Mrs. Smith are in their 70s, 4 children and 12 grandchildren, big family, all the grandchildren are minors. Mr. Smith is a 50% shareholder in a family company with his younger brother. They manufacture soft furnishings. It's a trading business, so it gets business relief. The company is now incorporated. It started off as a partnership, but as it's expanded, they sought the benefit of incorporation. They're also advised to enter into a shareholders agreement, and that's something which I'd strongly advise business owners do, either a shareholders agreement, partnership agreement, if there isn't one in place. And I'll explain the thinking behind that. Mrs. Smith hasn't been involved in the business at all, no interest in it whatsoever. Mr. Smith's share of the business is about £1 million. They've also, as Zara mentioned previously, as most clients do, they have a family home, cash and investments, and pension. And then they came to us to seek advice on the options of maximising basically their tax position, and also to provide for grandchildren. We've got a business relief will structure, which is beautifully designed. Thank you, Zara, for doing this. I think from my point of view, when client circumstances get more complex, what you actually are looking for is a structure. It puts something in place that is flexible enough to bend to whatever your circumstances are. The way in which we do this is normally through the use of a discretionary trust, and I'll talk that through in a minute. Before getting on to talking about the will, I never like to look at things in isolation. I very much start with the big picture. You know, what are Mr. and Mrs. Smith looking to achieve? What are their plans in relation to the business? When is Mr. Smith thinking of retiring? Have they got a shareholders agreement in place? On the bottom right, we flagged up shareholders agreement, including cross options and key man insurance. It really goes back to the point that I made a few minutes ago. If you, as a business owner, have entered into a binding contract for sale in the event of your passing in relation to your shares in the business, then you won't get business relief on the value of those. So the way around that, which we often encourage clients to do, is to look at their shareholders agreements and put in what are called cross options. So there's an option for the other shareholders to buy the shares from your estate, or an option from your estate to sell the shares to the other shareholders. One issue which a lot of our clients face is actually how do you extract value from the business in the event of death. As mentioned before, Mrs. Smith has no interest in the business. So from her point of view and the family's point of view, what they're looking to try and do is extract the value out of the business. But how do you do that? How do you make sure that you have enough money in place for the shareholders to buy the shares from the estate? And the easy way of doing that is normally through key man insurance. You put in place effectively life insurance, which is normally funded by the business, and it provides the shareholders with a fund of money sufficient to buy the shares from the estate of the deceased. And you put that in the shareholders agreement and link it together. Normally we work with our clients' companies' accountants and also IFAs to put the structure in place. With Mr. Smith's will, the value of his interest in the business is about £1 million. Everything else over and above that, we've encouraged Mr. Smith effectively to leave to Mrs. Smith, because you get the benefit of spouse exemption. So the shares in the business effectively go into the discretionary trust. The discretionary trust then very much depends on what Mr. Smith has agreed in his shareholders agreement. But if he has the cross options, which we hope he would have, then it may be the other shareholders with a key man insurance buy the shares effectively from the trust. So the shares go to the other shareholders, they then run the business. The discretionary trust then has in it cash of £1 million. Now, they've got a number of options as to how they might use that cash. They can either keep the money in the trust and support Mrs. Smith. They might do that if Mrs. Smith has capacity issues or is in a nursing home and maybe they don't want to pay a large amount of money over to her, which might potentially be swallowed up in care fees. Hopefully Mrs. Smith is fit and healthy and will be around for a long time. And one way of getting the money over to Mrs. Smith is to effectively lend the money to Mrs. Smith in return for an IOU. Quite a common arrangement that we use with discretionary trusts. So Mrs. Smith has the cash, just the same as if Mr. Smith had left it to her in the first place, but she actually has a corresponding debt against her estate for the £1 million, the value of which can be used to reduce her estate for inheritance tax. Mrs. Smith then has complete freedom to do what she wants with the money and with other assets in her estate. She may want to talk to us about making gifts down to children, potentially grandchildren. One client that I had, they didn't have a cross option agreement. So what happened is the shares went into the trust and Mrs. Smith, as we'll call her, actually bought the shares from the trust. So the trust ended up with cash and Mrs. Smith ended up with the shares. Mrs. Smith was actually involved in the business. What happened is she then ran the trust as, and we are still running it, as effectively a grandchildren's trust. The idea behind it was to support her grandchildren, particularly through school and university, to get a start in life on the property ladder. Property's extremely difficult for youngsters to get on. So that was the idea behind that, was to use that trust structure to help support the family and particularly grandchildren. Mrs. Smith was fortunate in that she had cash available to enable her to buy the shares from the trust at a proper market value. She had to pay stamp duty, which is 0.5%. So on a share value of £1 million, you're looking about £5,000 of stamp duty. Mrs. Smith then actually held on to the shares for 2 years, reacquired business property relief, and she has since actually gifted the shares down to children. She's now been left effectively with money out of her estate. That's passed into the trust, and we're running the trust for the benefit of the grandchildren. It is a very flexible structure, and what I think is useful for clients really is to sit down with each client, because each client will be very different, and I may talk to another client and their concerns will be very different. They may not have grandchildren, they may have children, the children may have issues. As Zara mentioned, family dynamics can be very difficult. But it's flexible enough that you can effectively adapt the will to cover any circumstances. If at the time Mr. Smith passes away, he is no longer a business owner and he spent money during his lifetime and the value of his estate is within his inheritance tax allowances, you can, if you want to, effectively wind the trust up within 2 years of Mr. Smith's passing, bring it to an end, and it's treated for inheritance tax as if it never existed. So you even have that option available if it's appropriate to do so. Sorry, it's quite technical. I think the key really is to sit down with the client to find out what you want to do and to see whether or not this sort of structure is appropriate. I've got a number of clients who own businesses, but they are effectively the business. All the knowledge and advice is in their heads, and they go out and talk to clients and they charge for their time in doing so. But actually, if they weren't around, the business wouldn't exist. And for that type of client, this structure probably isn't actually appropriate. A more straightforward structure, maybe leaving everything to each other and down to the children, just simply using spouse exemption would be the way to go. I hope that's been helpful. On a related note, business lasting powers of attorney, we thought we'd flag this up. I'm not going to go into a lot of detail, but just to make people aware that it is something that lots of our clients do. the question really is, if you were in business and God forbid you lost capacity, what would happen? Who would pick up the reins and help manage the business? Would your spouse be an appropriate person to do that? Do you have other people within the business who would be better placed to help? Not an easy conversation to have, but something which I think most business owners should give some thought to. And it's something I know that we do for lots of our business clients. Sorry, Zara, if you'd be kind enough to move on to the next slide. We just always finish off by setting out some of the sort of complications which people face in their lives and when to seek advice. Lots of our clients have assets abroad or are domiciled abroad and have assets in the UK. Lots of issues around marriage, divorce, remarriage. We see lots of clients in second or third marriages with children from different relationships. And quite often, the glue that binds people together is often the deceased, the parents. And when one or both of them are no longer around, relationships can struggle. And we see that quite a lot, unfortunately. And again, it's having a structure in place to help support that. Difficult family relationships. I've had lots of discussions with clients about relationships with their children or with siblings or even with parents. Business assets, obviously we touched on that today. We've got a number of clients who we look to support when they have disabled or vulnerable beneficiaries, quite often children or other family members that they want to support. Where your estate is above £325,000, it's always good to seek advice, even if it may be that you're within £1 million and you have enough allowances and children. It still is sensible to put an appropriate will structure in place. Care home fee funding, that's a big issue for lots of our clients. And again, we can put a will structure in place that would help mitigate some of that and also talk through the options for clients. And the key really is getting advice early. I've got quite a salutary lesson from a client of mine who came to see me after he transferred. Well, he sold a property to his son, but at an undervalue. And the property was actually substantially more valuable than he sold it for. So that bit of it, the bit over the sale price, was effectively treated by the revenue as a gift. But a gift does give rise to capital gains tax. And I had to tell him the very unpalatable news that he had quite a large capital gains tax bill. I think it was over £60,000 in the end. And you just wish that he'd come to see me or come to speak to his accountant before doing it. So I think the key is, if you are thinking about transferring any value to anyone, please take advice. Because once you've done it, it's often too late to unscramble it. And like my client, you could end up with a rather unpleasant and very much unwarranted and wanted capital gains tax bill. I hope that's been helpful. Thank you very much for your time, and very much open to questions, and I'll be delighted to answer any questions you might have.
Thank you very much, Elliot and Zara. Goodness me, as always, seek professional advice. Do we have any hands up? Because if not, I've got a question I want to ask. I'm going to ask one.
Yep.
So this is a business one. So what if my business has trading and non-trading elements, e.g., investment properties, which are generating rental income, hopefully, not necessarily during COVID, but hey, can my interest in the business still benefit from business relief?
Right. Then, Zara, if you wanted to kick off with that.
So as Elliot said, business relief applies to businesses that are wholly or mainly trading. The government's focus is on encouraging entrepreneurial activity. The business is looked at in the whole, so the business has to be wholly or mainly trading, which doesn't disqualify businesses that have an investment element. But if they become too prominent, then you run the risk of disqualifying business relief on the entire business. The revenue don't apportion it and say, well, this is 80% trading, 20% investment, therefore we're going to give 80% business relief. It doesn't work that way. It's an all or nothing relief. I have one client whose business is a hotel business. It's a very beautiful hotel, well run in central London, but they've also, before, again, not necessarily seeking advice early, they've also brought some investment properties into the fold. Now, throughout COVID, the hotel side of the business hasn't done very well, but the investment side of the business has conversely done quite well. So the majority of the income that is in the business at the moment is from the investment element rather than from the trading element. So if something was to happen at this point, you can sort of almost guarantee that the revenue would disqualify relief on the entire business, and that would be, you know, again, this is something they've done without taking appropriate advice before they did it. One solution is to hive off the investment side of the business into separate companies and sub companies and subsidiaries. The difficulty with that is that if you put them into the structure, then try to carve them out, you then have other tax issues such as stamp duty, capital gains tax. So it's always best, as Elliot said, to seek advice early, because you can still bring them within the fold of the business and preserve business relief on your main business. It just has to be structured correctly. So the key is to get advice early to make sure that you don't do anything that compromises your business relief. Because as we said, it's a valuable relief 100% where it applies. And if you've lost that on your entire business, then the entire value of that business will fall within the scope of inheritance tax.
Thank you very much, Sarah.
I was just wondering, sorry, Ella, one thing we do see with lots of clients is where they've actually got quite a lot of cash in the business. That also causes problems. I've got one client who's got a lot of cash, and particularly for income tax purposes, it's the advice from an accountant, and it's not uncommon for people to do that. The revenue do look at it pretty closely. I had another client of mine who also had a lot of cash in the business, but we were actually able, unfortunately passed away, but we were able to show that they had the cash because they were buying new premises and they were actively looking at doing it. It's just unfortunate he passed away before they'd found somewhere. So we were able to get business relief on it. But if it's just cash and you can't justify having that much cash in the business, then they won't give you the relief on that.
You've got to be able to show that that cash is earmarked for a business project.
Yeah. Thank you. I understand that one. This question was posed prior to the to today's event, and I've been asked to say it because this doesn't relate to me. But the question is, my estate's worth over £2 million. What other options are there for me with regards to gifting with the view to getting value out of my estate, such as it qualifies for the residence nil rate band?
I've had quite a lot of discussions with clients in the last few years since residence nil rate band came in, where I've got clients who are some way above the 2 million, anything up to sort of £3.5 million. And I actually got a couple of clients I'm speaking to who are well into their 80s, who are in that fortunate position, that they're in that situation. And we are actually looking at making substantial gifts, buy them down to children. Now, they're all aware that they have to survive 7 years for the value of it to fall outside of their estate for inheritance tax. But actually, as far as the residence nil rate band is concerned, because the way the legislation is drafted, if you actually manage to get the value out of your estate on day one and you bring your estate down to below £2 million, you will bring back into play those tax allowances. So you'll get yourself up to £1 million of tax allowance rather than 650 for a couple. So that's worth doing. If, God forbid, they don't survive the 7 years, you have to bring the value of the gifts back into account, and they're all aware of that. But it would give them about another £140,000 of inheritance tax relief. I've got a few clients that I'm having that conversation with at the moment who are actively making quite substantial gifts to try and bring their estates down. It's not for everybody, but it is something that we do talk to clients about, and you can do that at any stage. I think comes back to the point that we were making about planning ahead and doing it as early as possible. You know, hit the 7 year clock, the sooner you can start that running, the better, really.
I think just also to sort of chip in is that inheritance tax planning depends on two things. It depends on the type of asset you give away, and it depends on what I call the quality of your recipient. I've got lots of clients that are sort of in their sort of 30s and 40s that are very wealthy, but inheritance tax planning options for them are limited because the only people that they would want to give their assets to are their children, who are minors and therefore cannot hold them yet. So inheritance tax planning for those sorts of individuals is much more limited. Again, you've also got to look at the type of asset, because if you look to gift away property, Again, if you don't do it carefully, or if it's not structured correctly, you could end up paying additional capital gains tax in your lifetime. You could end up paying additional stamp duty. So it's about, so it depends on two things: the type of asset and the quality of the recipient. So all of that has to be taken into consideration by your advisor when you're looking at strategies to implement.
Goodness, a lot of planning. As a chamber, we have quite a few. Oh, sorry, Elliot, were you going to say something? I jumped in.
No. I'm just agreeing with you.
We have quite a few businesses that are actually family owned, and this relates to one of them. And the question is, I've got a significant shareholding in a family business. He's actively involved in the business and has worked in it for the last 20 years. His wife has no interest or involvement in the business. Can he still appoint her as his, business power of attorney?
It very much depends on the nature of the business. And I think the question I have in the kindest possible way is, if she has shown no interest in the business whatsoever so far, is she the best person to step in and start making decisions in the event of his incapacity?
Right.
It's okay, if it's a property and financial affairs power of attorney, which it would be, it does cover both physical and mental incapacity. So if he simply becomes housebound and is capable of giving instructions, that might just about be okay. If he loses capacity and she has to step in, or vice versa, he has to step in, throw around it is. It's, and she's never been involved. Is she that, she has to act in his best interest? She probably shouldn't be appointed. I think that's the bottom line. And she probably ought to turn around and say it's not appropriate really for her to act. It may be that he has either other family members. I've got lots of clients who've got children involved in the business. Maybe one of them might be appropriate, or even your co-shareholder, if you trust them implicitly, but you have to, or partner. Quite often where you've got businesses where, such as solicitors or accountants, if you are appointing someone to act as a business LPA, they have to have the same qualifications as you to be able to practice effectively. So if it was myself or Zara, for example, we'd have to appoint another solicitor really to act on our behalf.
So I suppose the answer really is also at all times, think it through, seek professional advice. We got any little yellow hands, Ed?
We have. There's a hand up from Terry.
Oh.
Hello, good afternoon. Thank you very much for taking this question. If you've got elderly parents that have got obviously their own property and an estate, and then there's 4 children, as you explained, when the parents die, and the will says that it gets dispersed equally to the 4 children, whether one of them has got an estate that's quite sizable and the other 3 haven't, do they still get the same taxable, or would it be best to say bypass that person and put it onto their children?
I don't know, Zara, if you wanted to answer this.
Yeah, that's always possible. I think often, yes, if you're looking at that scenario, if you've got one child out of the 4 that is, reasonably wealthy, and inheriting from their parents will only increase the value of their estate. I mean, often as people get older, getting an inheritance from parents or from older generations can sometimes be a bit more of an inconvenience than a help, unless you are in need of the finances, because that comes into your estate, that inflates the value of your estate. You can do what is known as a deed of variation within 2 years of the parents passing, to basically divert what that person would have got down to your children instead. So that's entirely possible. What that does is that for legislation purposes, the deed of variation basically treats what is going to your children as if it had been a gift made by the deceased in their will. So you drop out the picture entirely. If you inherit from your parent and you then make a gift of that money to your children, you've put yourself in the middle, and you then have to survive the 7 years before the value of that gift falls out of your estate for inheritance tax purposes. By doing the deed of variation, you slot yourself out the picture, so the gift goes directly from the parent to the grandchild, so there's no 7-year rule. So it's a really neat trick, I guess. So one of the conversations that I always have with my clients when we're dealing with probates and when we're dealing with estates once the beneficiaries have an idea of what it is they're going to receive from that individual's estate, one of the conversations that I always have with them is that, are you minded or inclined to do any tax planning? Because if you are, now is the opportunity to do it. Once you've inherited that money from them and it's passed through your bank account, it is in theory possible, but it becomes a bit more difficult to do because that paper trail showing that the asset has gone to you has already commenced. If you don't want to take the benefit of that asset and you want to pass it on down to children, let's do it as quickly as possible once you know what you're going to get and how much you want to give away. You don't have to give away the whole entitlement. You can give away a part of it. So you can keep a portion of it. You don't necessarily just have to pass it outright to your kids. It depends on, again, it depends, as I said, on the quality of the recipient. If your child is a minor, you may wish to create some sort of trust to hold that fund in for them rather than giving it to them outright. So there are a whole host of options available. But again, it's about seeking advice early and before coming into that inheritance yourself, taking advice on what your options are. But the short answer is yes, it's possible.
Thank you. Thank you very much.
Thank you, Sarah. That was very good. I've got one more question. Have we got any more hands?
We do, Helen, yes. We've got Diego has got his hand up.
Okay.
Are you ready, Diego?
Hi, Elliot. Hi, Zara. Thanks for the presentation. Just very quickly, you kind of mentioned there was gifting of shares in the business. I must have missed something out there. Is it possible to gift shares from a company? Currently, myself and my wife, we own the company. We've been trading for about 21 years. Obviously, we've got 3 commercial units as well. So we're kind of thinking of gifting shares to the kids. And is there any tax implications of that as well?
There are sort of couple of taxes at stake really that you need to think about. The first is inheritance tax, and it very much depends on the nature of the business. If it's
It disappeared.
Sorry, apologise for that. I was gambling away. Nobody was listening, so I do apologise. Sorry. I was just going to explain that there are a couple of taxes at stake that you need to give some thought to when you're looking at gifting shares. The first thing that we'll need to look at is inheritance tax. If it's shares in a trading business and you've held the shares for at least 2 years and business qualifies for 100% business property relief, you can give those shares away for inheritance tax at nil value. You'd have to make sure you still want to survive. It sounds awful. You still want to survive 7 years for the implications of it to fall outside of your estate. So it comes back to the point that I was making. If you're thinking of selling the business in the next 7 years, you need to be a little bit careful about that. But if it's ongoing and you plan on being around for a lot longer than that, then that's fine. The second issue is potentially capital gains tax. A gift is a disposal for capital gains tax. So you need to sort of think it through with the accountant, really. And you're likely to get entrepreneurs relief. So that will help reduce the tax bill to sort of 10%. But it's something to factor in as to whether there is any CGT, and if so, if it's palatable or not. You may be able to claim holdover relief. I know that might be maybe more your things are if it's a transfer of business.
Yeah, you might get some holdover relief on it, but again, it depends on the type of asset and it depends on what the business is.
Yeah, I think the other things to sort of think about really are the recipients point that Zara was making a few minutes ago about the recipients of the gift and how much control do you want to retain after you've made the gift. Because you could have a think about maybe creating different classes of shares which give you different entitlements. So you could maybe hold on to a class of shares which give you more control and give away some shares or value in the business, which would then entitle your children maybe to some income, but maybe not quite as much control. But you can do that. It's such a flexible arrangement. But I think it goes back to sort of getting advice really to make sure it's suitable for your circumstances. But really it's inheritance tax and capital gains tax, the two taxes really you need to.
And I think you mentioned you've had the business for 21 years, so there will be a lot of inbuilt gain that's accrued over that period. So the capital gains tax is probably likely to be the more immediate issue, and having a look at whether holdover can be claimed to defer that gain going forward, that's what we need to look at.
Thank you.
Thank you. Was it Christopher? Did I see your hand up?
Well, Because obviously it's not really the appropriate hand up emoji reaction.
Don't worry, real one.
My question was though, I know this is a very basic level and this is going back to the start, can you in any case in your will give your estate to a very close friend of yours? Say for example, you had no family, like literally no forms of family from brothers, parents, grandparents, uncles, aunts, for example. Are you allowed to give your estate to a friend? Or does it have to go to the crown?
Yeah. I mean, in English law, we have a concept called testamentary freedom, which means you can do pretty much whatever you like within your will. So yes, if you were to pass away without a will, that's where that flowchart that I put up comes into play, where they will look at who your wider family members are, and they will inherit. So if you want to override that position, and if you want to make sure that your estate goes to a close friend or family member, then yes, you can put that in your will. Just a few things to be aware of though, that if there are certain members of your family that have an expectation of inheritance from you because they are people that you financially support, then that could be problematic if you don't make any provision for them, for that individual in your will. But if you don't have those kinds of ties with anyone, and you've got good relations with your family, but you just don't necessarily want to leave them anything, or you don't have any family, then yes, you can in theory leave your estate to whoever you want without any questions asked. Again, subject to, if the value of your estate is above your tax allowances, they will receive your estate, but they'll have to pay tax on it. Sorry, I'm giving very long answers.
Right. I think we're nearly at the end. So I would like to thank Zara and Elliot. This has been really, really interesting. Thank you. I don't know if anyone who's here today was that we had a few weeks ago, we had a commercial and residential landlord and tenant event. And on the 20th, Tuesday, the 20th of July, we're going to have another one, the update. So that's up on I think that's just coming up on the website quite soon. So we'll be emailing those details out. So thank you very much for coming along today. And again, thank you, Zara and Elliot, and thank you, Thackray Williams. Team Thackray Williams did a brilliant job. Thank you. And thank you
very much for inviting us. Thanks, everyone.
Thanks for having us.
Bye.
Thanks. Bye.
Bye. It's great. Thank you.